So welcome to this video. In this video, we are going to discuss about taxation of business profit. And as far as taxation of business profit is concerned, we are mainly concerned with the four important issues, if they are not three. The first one, we need to know which expenses are allowed, which expenses are not allowed, which income is allowed, and which income that is not allowed. So those are the four aspects that you need to look at, or you need to be very careful when you are dealing with a question on business income. So we are looking at the taxation of business profit of individuals. Of course, the taxation for business profit, whether it is a company, whether it is an individual business, whether it is a partnership, any form of business organization that we are going to look at, the taxation of business profit or the computation for the taxation of taxable business profit is the same. What you need to know in this case is to know what are my business expense, what are the business income, which income is allowed, which income is not allowed, which expense is allowed, which expense that is not allowed. That is where all the question related to business profit rotates. So if you look at the definition which is given by the tax law as what we call business profit, a business profit is income from all the business activities minus business expenses, and we also include proceeds from the disposal of a business asset. So we get income from all the business activities minus business expenses. Then we also add a proceeds from the sale of a business asset. So for individual income, so there is a tax exemption for income accrued from savings and employee share scheme within the company. So if there is an income from saving or income from employee share scheme, so those incomes are exempted as far as taxation of individual income is concerned. So when it comes to agriculture activity, when you're looking at the agriculture activity, when it comes to agriculture activity, we mean agriculture, that is crop farming and forestry. We look at livestock, poultry, all those ones are considered under agriculture activities. So the income from agriculture activities, we exempt 12 million. So we get what you have generated from your agriculture activity, then we less 12 million to get the taxable income from agricultural activities. Now, in some cases, you may have assets or claims which are in foreign currency. So in the case some assets are held in foreign currency, or in the case some claims are held in foreign currency, then you need to make a valuation. Look at the value of the asset at the beginning and the value of that asset at the end, or the value of the claim at the beginning and the value of the claim at the end. Then get the value of the asset at the end less the value of that asset at the beginning, and then what you get, it can either be a gain or a loss on valuation. So if it is a gain, that gain is going to be added when you are computing to your taxable income. I said, for example, a company may have a bond which is in dollar. So if a company has got a bond that is in a foreign currency, or the company issued a debenture which is in a foreign currency. So if a company has issued a debenture that is in foreign currency, at the end of the period, we are going to look at what is the foreign exchange rate, or what called the spot exchange rate at that period. Then we also look at the exchange rate at the beginning of the period. Then we look at the exchange rate at the end, or the value of the asset at the end of the period, minus the value of the asset at the beginning. Then we determine whether there is a gain or a loss on foreign currency. So if it is a gain, as I said, we are going to include it in our taxable income. If it is a loss, we shall less it from our taxable income. So how do we compute? A simple pro forma on how to compute this. We can begin with in case you have a profit and loss, you can look at your profit and loss. If there is a profit or loss, then consider each item of expense. After you start with your profit and loss. So after looking at the profit and loss, then look at your expenses. So if the expense is allowed, then you are going to leave that expense. But if the expense is disallowed or the expense is not allowed, then you are going to add it back to your profit. So that is step number 2. Step number 3, consider each item of income which has been created. So look at your incomes which were added to your profit. If the income is allowed, or if it is a trading income, you leave. If it is non-trading, then we less. Also consider any item which should have been for example, consider those expenses which should have been removed or which should have been debited to your profit and loss and were not debited, you less. And also consider those income which were supposed to be added and were not added, and then you add. A simple pro forma that can help you to compute. As I said, you begin with your profit before tax, either it is a loss or it is a profit. Then add back expenses that are not allowed, less those expenses that are allowed but were not recorded, less also those incomes that were added but they are not allowed, add incomes which are allowed but were not recorded. Then you can less your capital allowances, which is the investment allowance and the depreciation. Then you are going to get your taxable income. So let's look at those expenses that are allowed for tax. Please, this is one of the most important part as far as this part is concerned of business profit. I said whether you are taxing a company, you are taxing an individual business, you are taxing a partnership business, the taxation is the same. You need to know which expenses are allowed, which expenses are not allowed, which income is allowed, which income is not allowed. So I think you have seen in our pro forma on how we compute. So which expenses that are allowed for tax? Number 1, they must be incurred for direct purpose of the business, meaning that those expenses were incurred in relation to the business activity. So they directly relate to the business activities. So if the expenses directly relate to the business activities, then those expenses may be allowed. Number 2, they correspond to real expense and can be sustained with proper receipts, meaning those expenses, they have evidence. You have the supporting documents for the expenses. So if you don't have supporting document for expenses, then we don't include those expenses in our computation. They are not going to be allowed. Number 3, they lead to a decrease in the net asset of the business. For example, depreciation, impairment, bad debt. So those are expenses that leads to a decrease in the net asset value. Then they are used for activities related to the tax period, meaning those expenses must be relating to that particular tax period. They are within the tax period. For example, in that case, you ignore the prepaid expenses. So which expenses that are not allowed as per Article 26? So dividend declared from and profit paid out of to the beneficiaries. So if a dividend is paid or a dividend is not allowed, reserve allowances, saving and other social purpose fund, unless those are provided in the law, they are not allowed. Fines and similar penalties, donations, save for donations given to non-profit making organizations, those are not allowed. So donation given to charitable organization which should not exceed 1%. So if an organization has made a donation to a charitable organization, so that donation should not exceed 1% of the turnover. So if a donation is made to a business organization, the donation is not allowed. But if the donation is made to a charitable organization, then you should calculate 1% of the turnover. If it exceeds 1%, the difference should be added to your taxable income. But if it is below, then that donation is allowed. Then we also have income tax is not allowed. Recoverable VAT is not allowed. Personal consumption expenses, they are not allowed. Entertainment expenses, except sporting activities for employee. So entertainment, the only entertainment that is allowed is entertainment that relates sporting activities for employees. Other entertainment, they are not allowed. 20% of expenses paid on business overheads, which cannot be separated. So if you have business expenses and you cannot separate those business expenses from business and private, or if you have expenses and those expenses cannot be separated from private, then 20% is not allowed and 80% is allowed. So you get an expense, 20% should be added back to the taxable income. We also have management, technical fees, and royalty fees paid to a non-resident person exceeding 2% of turnover. So if there is a management fee, a technical fee, or a royalty fee which is paid to a non-resident and that payment is exceeding 2% of the turnover, then the difference should be added back to your taxable income. So it is not allowed. Then we have interest from a loan, between a loan from a related party. So if there is an interest on a loan from a related party, for example, you have company A Limited and the company B Limited, and these are related party, and one company has given a loan to another company, and that loan is exceeding 4 times the equity of the other company, then we only consider 4 times of the loan should be 4 times. Any excess of 4 times, it is not allowed. Example, if the company A has given a loan to company B, and the company B has got a capital of 100 million, but company A gave a loan of 600 million. So in this case, if you get 100 million times 4, we get 400 million. Meaning the 400 million given will be allowed, but excess of 600 minus 400, the 200 million, cannot be allowed. So that interest on the 200 million should be added back when you are computing your taxable profit. So let's look at how do we value stock. So the law provides that when you are valuing stock, you are comparing the lower price between the cost price and the market price. So you look at the market price and the cost price, whichever is lower should be the one to use it when you are valuing stock. So another important thing as far as computation of business income is concerned is depreciation. So depreciation, although we say depreciation is allowed, but the depreciation that we allow in tax, it should be calculated according to the tax laws. So the tax law provides guidelines on how to calculate depreciation. So when we are calculating depreciation, for industrial building, for buildings and heavy industry equipment, we use 5% of the cost. So when you are looking at depreciation of building, depreciation of heavy industrial equipment, you calculate at 5% of cost of acquisition, construction, refining, rehabilitation, or reconstruction. So that is how you are going to calculate depreciation on building and heavy industrial equipment. You are calculating on the cost. For intangible asset, we calculate at a rate of 10%. information and communication system which have got a useful life that is above 10 years, we also calculate at 10%. Land, fine arts, antiquities, jewelries, or any other assets that are not subject to wear and tear or obsolescence are not depreciated. So you cannot depreciate land, you are not going to depreciate fine art, you are not going to depreciate jewelries. These assets are not depreciated. Computers and accessories, you are going to depreciate those which are below 10 years, you are going to depreciate at 50%. Then any other business asset, you depreciate at 25%. Please, I want to repeat this because this is very critical when you are computing depreciation. I said building and heavy industrial equipment, then we depreciate at 5%. ICT equipment with 10-year useful life and more, we calculate at 10%. Land, fine art, jewelries, they are not depreciated. You depreciate at 0%. Then computer and accessories, which have got a useful life that is below 10 years, then you depreciate at 50%. Any other business asset, you depreciate at 25%. These two assets, that is computer and accessories, information and the communication system, and then other business assets, we depreciate them in full. And these assets, the basis of depreciation is reducing balance. Other assets mentioned above, apart from this land, you depreciate on straight line. But these ones, the computer and accessories, information, whose life below 10 years, then any other business asset which is not mentioned above, you depreciate 25%, but you calculate depreciation on reducing balance. So that one is very, very, very important when you are calculating depreciation for assets. So building, 5% cost. Heavy industrial machine, 5% straight line. Intangible asset, 10% straight line. ICT equipment with 10-year useful life, 10% straight line. Computer and accessories, those with whose life is below 10 years, 50% reducing balance. Other business assets, 25% reducing balance. So depreciation of leased asset. Now, when we are depreciating leased asset, we need to look at the types of lease, the operating lease and the financing lease. Now, if it is an operating lease, it is the lessor to depreciate the asset. The lessee does not depreciate. But if it is a finance lease, the asset will be depreciated by the lessee. So in this depreciation, I think you are going to apply the IFRS 16 standard on how to depreciate these assets, since the law does not mention on how to depreciate. So when we are calculating depreciation, we get our cost or written down value. What I mean here is that if the asset is depreciated on a straight line, you are going to look at its cost. But if the asset is depreciated on reducing balance, then you are looking at the written down value, or what we call the net book value. Now we add the new asset you have purchased. We less the disposal, any disposal that has been made. But when we're looking at the disposal, we consider the sale price of the asset, not the cost. Then we get the depreciation basis, that is the value we are going to calculate our depreciation. Then we apply our depreciation rate, then we get the depreciation. So this is the format that you can use when you are calculating your depreciation for the asset. Remember, I say if you are depreciating on straight line, you recognize the cost. But if you are depreciating on reducing balance, as you have seen in our previous slide, you recognize the written down value, or what called the net book value. The other thing that is important is that if the depreciation basis is less than 0, that means it has become a negative, then you are going to recognize a gain. If your depreciation basis has become less than 0, then you cannot depreciate a negative. In that case, you are going to consider the whole amount as an income. But if the depreciation basis figure does not exceed this amount, meaning from this amount below, we don't depreciate. We take the whole amount as a depreciation charge in your profit and loss. So another thing we can talk about as far as looking at the expenses is the training and research expenses. So if the training and research expenses are aiming at promoting the business activities, then those research and training expenses are allowed. But if they are not aiming at promoting business activities, then they are not allowed. And we cannot allow a research activity to purchase land or to rehabilitate land. Those ones are not allowed when we are computing our tax. So another important thing in a computation is a bad debt. We said a bad debt is allowed, but the bad debt that is allowed, it should be specific. You are very sure that a customer is not going to pay, and you have the evidence which shows that the customer is not going to pay. If you don't have evidence that the customer is not going to pay, that one is a provision, and a provision for bad debt is not allowed. So for bad debt to be allowed, it must meet certain conditions, and some of these conditions are these ones. So if an amount corresponding to the bad debt was previously included in the income of the taxpayer. So if that bad debt you want to write off, that bad debt was previously in your sales, then you can look at it. I'm not saying that you can allow it, but you can. Another important condition is that if the bad debt is written off in the books of the taxpayer, it was previously included in the sales, and the taxpayer has written off that bad debt from the book. And this one is the third one is the most important to recognize a bad debt, that a taxpayer has taken all the possible steps in pursuing the payment and has shown a court decision declaring insolvency. You can have number 1 and number 2, but when you don't have number 3, it is still a provision. And if it is a provision, it is not allowed unless it's meeting the other point that we are going to discuss on the next slide. So if the bad debt is 3 million and below, you may not need to meet condition 1 and 2, meaning and 3. And this bad debt has taken a period of 3 years. You may not wait condition number 3. As long as it was included in your previous sales, that bad debt has been written off, it is enough. As long as it was included in your previous sales, you have written off that bad debt, and that bad debt is 3 million and below, and it has taken 3 years, then you can allow that bad debt to be considered as an expense. But if not, then it has to consider the other 3 conditions. If it does not meet the other 3 conditions, then it is a provision, and the provision is not allowed. So let's look at the loss carried forward. In a tax period, the taxable profit can become into a loss. So if the taxable profit has become into a loss, the taxpayer is allowed to carry forward that loss for a period of 5 years. So this loss is offset from the taxable profit. So when you are calculating, you are getting, before you calculate the tax, you get the profit minus the loss that you have brought from the previous period. So when we are carrying, we don't consider a foreign loss. So during the tax period, a foreign sourced losses cannot be deducted from either present or future domestic sourced business profit. So if you have got a loss, if for example you have a business outside, and in that business you got a loss. The loss you got from a business outside cannot be brought to offset the present profit here. What we only recognize here is the income. But if it is a profit, a loss, then the loss you leave it where you generated it. You cannot bring it here to offset the profit here or to be carried forward. Another important thing still when looking at a loss is the change of ownership. In case there is a change in ownership and the change in ownership is above 25%, in that case a loss cannot be carried forward. For example, we had the company A, and the company A during the period sold part of its stock, and it maybe it sold 30% of its shares to another investor. So in that case, there is a change of ownership which is above 25%. So if there is a change of ownership and the change of ownership is above 25%, then a loss cannot be carried forward. So that is what we can talk about as far as taxation of business profit. Remember what I've said when we are starting this video. You need to be very careful with those 4 important aspects I've talked about. You need to know what are my business expenses, which expenses are not allowed, which expenses are allowed, which income is allowed, which income is not allowed. Please try to follow those explanations that we have talked about in this video. The moment you get this, you cannot be challenged with a question as far as business profit is concerned. Either it is a company, it is an individual business, or you are dealing with a partnership, because the general principle for taxation is the same. The only thing that is going to come is some information, but if you have got what we have talked about, I'm very certain that you cannot be challenged with this part of tax. So watch my next video where we are going to look at capital deductions.